Hello and welcome to House Lux Estate, your go-to channel for all things investment and real estate. Today we're diving into a topic that's crucial for every investor out there: minimizing investment fees. You see, these fees may seem small, but they can eat into your returns over time, making a significant difference in your financial growth. But fear not, there are ways to keep these costs down. In this video, we will explore effective strategies for minimizing your investment fees and maximizing your returns. Before we delve into the strategies, it's important to understand what investment fees are. Investment fees are charges that you, as an investor, pay for services rendered in managing your investments. They are like the price tag for the expertise, time, and resources that investment professionals put into managing and growing your wealth. There are several types of investment fees. First, we have management fees. These are usually a percentage of the assets being managed and go towards compensating the portfolio manager for their services. If you're invested in a mutual fund or an ETF, you're most likely paying management fees. Next, we have transaction fees. These are charges you incur every time you buy or sell an investment. If you're an active trader, these can add up quickly. Then we have expense ratios, which are essentially the operating costs of a fund, expressed as a percentage of the fund's total assets. This covers everything from legal expenses to administrative costs. Lastly, we have load fees. These are sales charges that you pay when you buy or sell certain types of funds. They're called loads because they can put a heavy load on your investment returns if you're not careful. Now, why should you care about these fees? Well, even though they might seem small over time, they can significantly eat into your returns. Imagine you have a portfolio of $100,000 that grows at 7% annually. If you're paying 2% in fees over 20 years, you would lose nearly $40,000 to fees. In the world of investing, every penny counts. These fees might seem inconsequential at first glance, but when compounded over the long term, they can be the difference between a comfortable retirement and financial uncertainty. Now that we understand the impact of fees on our investments, let's explore ways to minimize them. The first strategy to consider is investing in low-cost index funds. Now you might be wondering, what exactly are these funds? Well, index funds are a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index. They provide broad market exposure, low operating expenses, and low portfolio turnover. The beauty of index funds lies in their simplicity. You're not trying to beat the market or outperform certain sectors. You're simply trying to mirror the performance of the overall market. This passive management style results in lower operating expenses, which directly translates to lower fees for you as an investor. Now let's contrast this with actively managed funds. These funds are managed by professionals who attempt to beat the market. They're constantly buying and selling assets, which leads to higher transaction costs. Not to mention, the management fees for these funds tend to be higher too. But here's the kicker. Despite the higher fees, actively managed funds don't necessarily outperform index funds. In fact, a significant percentage of them underperform compared to the market index. So you're essentially paying more for potentially less return. By choosing low-cost index funds, you can significantly reduce your investment fees. You'll enjoy the benefits of diversification, lower costs, and potentially better returns. Plus, you'll have more of your hard-earned money working for you rather than lining the pockets of fund managers. Our second strategy involves negotiating your fees with your investment advisor or broker. Now, you might be thinking, can I really do that? The answer is yes, you absolutely can, and here's why. Investment fees aren't set in stone. They're more like a starting point for discussion. The key here is understanding what you're being charged for and why. You see, fees can be layered, complex, and often hidden within the fine print. It's crucial to get clarity on these fees. Ask your advisor or broker to break down the costs for you. Once you have this information, you're in a stronger position to negotiate. Now you might ask, how exactly do I negotiate? Well, it's simpler than you might think. Start by expressing your concerns about the fees you're being charged. Be open and honest about your budget and what you're willing to pay. Remember, your advisor or broker wants to keep your business. If they sense that high fees might drive you away, they're likely to be more flexible. Negotiating isn't about being confrontational. It's about having a conversation and finding a middle ground that works for both parties. Don't be afraid to assert yourself. After all, this is your hard-earned money we're talking about, And finally, if your current advisor or broker is unwilling to budge on fees, don't be afraid to shop around. Other professionals may offer the same services at a lower cost. Remember, it's your money, and you have the right to negotiate how much you're willing to pay in fees. The third strategy is to consider working with a fee-only advisor. Now you might be wondering, what is a fee-only advisor? Well, a fee-only advisor is a type of financial advisor who is compensated solely by the client, with neither the advisor nor any related party receiving compensation contingent on the purchase or sale of a financial product. The benefit of this arrangement is that it eliminates a significant conflict of interest. Since these advisors don't earn commissions based on the products they sell, their advice is likely to be unbiased and in your best interest. They're focused on strategy and planning, not selling you something that may not serve your needs. But let's not confuse fee-only advisors with commission-based advisors. Commission-based advisors are compensated for the products and services they sell. This could potentially influence their advice, leading them to recommend options that are more profitable for them rather than what's best for you. So, if you're looking to minimize fees, a fee-only advisor could be a smart choice. They could help you navigate the often confusing world of investing, giving you advice that's based purely on your financial goals and circumstances, not on what will earn them the most commission. Remember, the aim is to keep more of your hard-earned money working for you in your investments, not lining someone else's pockets. With a fee-only advisor, you can be confident that they are working in your best interest, not their own. Our final strategy is to regularly review your portfolio. Now, why is this so essential? It's because your portfolio is not a set-it-and-forget-it operation. It's a dynamic entity that needs your attention to thrive and yield optimal results. Regular portfolio reviews are akin to health checkups. Just like you wouldn't neglect your health, your portfolio too deserves that level of care. This process helps you identify any hidden or unnecessary fees that might be eating into your returns. These could be anything from management fees, transaction fees, to expense ratios that you may not even be aware of. So how do you conduct an effective portfolio review? First, take a comprehensive look at all your investments. Analyze each of them in detail. Understand what you're being charged for and why. Next, compare these fees with industry standards. If you notice any discrepancy or anything that appears unjustified, don't hesitate to question it. Just as you would shop around for the best prices while buying goods, do the same with your investments. Explore other options, compare their fee structures, and see if there are cheaper alternatives that offer similar returns. And remember, this isn't a one-time process. Make it a habit to conduct these reviews at least once a year. It's your hard-earned money, so be proactive in ensuring it's working as efficiently as possible for you. By regularly reviewing your portfolio, you can identify and eliminate unnecessary fees, further reducing your investment costs. To wrap up, minimizing investment fees is a crucial aspect of maximizing your returns. We've explored a variety of strategies today, each with its unique benefits and considerations. We started by understanding the nature of investment fees. Remember, they can significantly eat into your earnings over time, so it's vital to be aware of them and know how to navigate around them effectively. Then we dove into the world of low-cost index funds. These are a great way to keep fees low while still maintaining a diversified and balanced portfolio. Next, we discussed the power of negotiation. Don't be afraid to challenge your broker or advisor on their fees. It's your money after all, and every penny saved is a penny earned. We also looked at the value of fee-only advisors. They are paid a flat fee for their services, avoiding the potential conflicts of interest that can come with commission-based models. Finally, we talked about the importance of regular portfolio reviews. By keeping a close eye on your investments, you can catch any unnecessary fees early and take action to minimize them. It's important to remember that every investment strategy has its risks and rewards, and what works for one person might not work for another. But by being proactive and informed, you can significantly reduce your investment fees and increase your overall returns. Thank you for joining us at House Lux Estate. Don't forget to subscribe for more insightful investment and real estate tips. Here's to smarter investing.